Hello friends, good evening to all of you, and today this is the ninth session for the BFM, that is the Bank Financial Management, and we are going to cover the very important thing that's actually related to module C of the BFM. So we'll be starting with the module C of the BFM, but before that we are to solve two case studies based upon the structural liquidity ratio and further one case study based upon the Basel 3. So I'll be letting you know each and every concept related to it, and further we have already learned the basics related to liquidity management in the previous video. So if you have not gone through that particular video, you must be following the channel right now, subscribing the channel right now. You must be joining the paid membership over there, and further you'll be able to join the videos over there. Why I'm saying so? Because the videos are available as promised for 24 hours free of cost when those are live, and then after those are available only to the paid members who have basically subscribed to our YouTube channel, and further also you have who have basically subscribed us on the different platforms over there. So let's do continue the particular video, and further please do confirm the audio quality at the earliest so that we can proceed. So now we will be starting from this video onward. We are going to start the new series and further the new chapter, that is a new module from the new chapter, that's actually the treasury management module C. But before that we'll be solving a case study, right? So let's have a look at the case study over here. The audio quality is working fine, so let's start the session over here, and it's somewhere like related to the liquidity coverage ratio. But before that we'll be covering related to the structural liquidity statement liquidity, right? So it's the case study is actually based upon the structural liquidity statement, the statement which is to be given to the Reserve Bank of India. It's actually based upon the same. So I'll be giving you all the data related to it, and further based upon the same we'll be solving it, right? Okay, so first of all, it's actually the data given related to a structural liquidity statement is to be prepared, and further as on 31st of December, let's say 2019, the things are to be prepared, right? And you'll be given with the data over there. Let me just copy the data and further paste it over here so that you can understand it very well. Let me just do it at the earliest. It will just take a moment. Just give me a moment related to it so that we can proceed. Okay, so in between, kindly, if you're having any doubt related to the previous module, that is module B, kindly please do let me know at the earliest. If you're having any of the doubts related to the previous sessions, do let me know at the earliest if you're having any of the doubts. Okay, so we are having the data over here, so let's move the data and further copy the data from here. So here is the data. Here is the data. Okay, so we are provided that we are having the structural liquidity statement, that we are having the structural liquidity statement over here, and further it is given that the volatility of the safe deposit is last 3 years is 12%. So volatility for the SF deposit is 12% in last 3 years, and maximum volatility for the CD, that is the current deposit, is 17.8% over here. And further for the fixed deposit, we are given the with the data over there, like for fixed deposit we are having 200 let's say crores or lakhs, which is basically starting from 28th of the February, and for the maturity date is given over here. So in the one column we are provided with the maturity, and the other column we are provided with the start date, and this is actually related to the amount which is given to you, the amount data which is given to you, right? And further the total FDR amount is given, and then interbank deposits are given, call money, repo, CDs, saving fund deposit, current account, and total liability is given, right? And we are to solve the questions based upon the same. So the first question over here that we are going to solve based upon the structural liquidity statement, that particularly says, this is actually related to the statement that we are going to solve over here. So the first question over here says, what is the amount of the current deposits to be placed in 1 to 14 days bucket? So if we basically are to talk about the 1 to 14 days bucket, we are talking about the 1 to 14 days bucket, what amount related to the current deposits will be placed in 1 to 14 days bucket? So kindly do answer over here at the earliest. We have to solve the question based upon it. So if we talk about the current deposits, the current deposit data is given something over here, that is given to be 180. This data is actually given related to the 180 over here, and also we are to place it in 1 to 14 days bucket, right? And for the volatility related to the current deposit is given to be, it is given to be 17.8%. It is given to be 17.8%. So on the total, if we say, the data particularly says that we are having the current deposit amounting rupees 520. Let's say 520 is the amount related to the current deposits over there. But the volatility related to same is 17.8%, which will be placed in what part? Which will be placed in 1 to 14 days bucket. So what particular amount from the current deposit account will be placed in the this particular bucket, that is 1 to 14 days bucket? It will be the volatile part. It will be the volatile part which will be placed over there. Is that clear? So we can simply be calculating the same. So it will be 520 into 17.8%, that is 92.56. So the answer over here is 92.56. It's actually related to the amount which will be placed in 1 to 14 days bucket, which will be placed under 1 to 14 days bucket. Is that particular part clear to you? Kindly please do confirm at the earliest. Kindly do confirm over here at the earliest if you have already understood this particular part, right? And after that, it's related to amount of saving fund deposit balance, which should be shown in the time bucket of 1 to 14 days. So far we have covered the amount of the current deposit. Now we have to cover the amount related to saving fund deposit, which is to be placed under 1 to 14 days bucket. Again, we have to calculate the amount which is to be placed in 1 to 14 days bucket, but it's related to saving fund now. Now for the saving fund, the total amount given over here is 960. In the saving fund case, the total amount which is given to you is 960 over here. So we'll be writing 960, but it's the total amount over there. Now let me just tell you one thing, that the volatile part would be what? Volatile part would be the one particular thing which will be some percentage, right? So volatile part over here is particularly given to be, maximum volatility is given to be 12% over there. It is given to be 12% over there. So 12% of 960 will be placed in 1 to 14 days bucket, and rest of the particular deposit will be placed in 1 to 3 years of the bucket, because that's a core deposit. So if we say the extra amount, that is 520 minus 17.8%, I'm talking about the current deposits right now. If we talk about the volatile part, the 17.8% from the current deposit and further 12% from the 960 of the saving fund deposit was the volatile part, which will be placed in 1 to 14 days bucket, but rest of the part will be placed in 1 to 3 years of the buckets, right? If you are not basically understanding what I'm talking about the buckets, or what I'm talking about the particular, let's say, maturity ladder, then you should be consider watching the previous video, right? So that's particularly explained in detail over there, right? So further, it's related to 960 into 12%. So the volatile part over here is 115.2. This is the amount which will be placed in the 1 to 14 days bucket, which will be placed under the 1 to 14 days bucket over here. Is that clear? Is that particular part clear over here? The next question, it says the interbank term borrowings. The interbank term borrowings will be indicated in what bucket? Kindly please do let me know. So interbank term borrowings is given to be here. Let me just highlight this particular thing. Let me just highlight the point over here. It says interbank borrowings is actually for this particular point, and further it says it is ranging from which particular date? It's ranging from November 19 and further up to January 20 over there. And this particular statement is to be prepared as on 31st December 2019. This must be taken care of. You are to take care of the same, because we will be considering the residual maturity from this particular point only, that is from the 31st of December 2019. So the 1 day maturity would be related to 1st January 2020, right? And for the 2 to 14 days bucket would be related to what? It would be related to from 2nd of January to the 14th of the January, right? Something like that, right? So it will be working in that manner. So we have to basically calculate the particular residual maturities from where? We have to calculate the residual maturities from the date from which at which we are going to prepare the statement, right? So that must be clear to you. Okay, so now in this case also, let me just tell you that we are basically considering that 31st January 2020 over there. We are considering it to be 31st of the January 2020 over there. So if we consider in what particular window those that is to be explained, so we have to count the days from 31st ahead of 31st of December 2019. So it will be related to the residual maturity, is actually related to, in case of the interbank maturity, the residual maturity would be what? So we have to consider residual maturity from which particular date? Kindly do answer at the earliest. We have to consider the residual maturity from the 31st of December 2019 over there. From 2019 31st December, we have to consider the residual maturity, and further it will be particularly from 1st of January, from 1st of January to particularly 31st of let's say January over there. 1st of January to 31st of January over there. So we can be saying we'll be having the data under what particular buckets. So we are having the different buckets. We are having the different buckets like in the case of SL, particularly structural liquidity statement, we were having the different buckets. One bucket, it was related to 1 to 14 day bucket. The other one, it was related to 15 to 28 day bucket. There were 11 buckets we basically talked about, right? We talked about the 11 buckets over there, right? And for the third bucket, it will be related to from 29 days, or let's say from 31st day. From the not from the 29 days, it will be the first bucket was for the one night, one day. That was for one day. And for the from 2 to 14 days was the second bucket. From 15 to let's say 30 days was the for the third bucket. And further it was related to 31 to 2 months. 31 to 2 months was another bucket, so it will be placed in this particular bucket. This interbank borrowing will be placed in the bucket from 31 days to 2 months over there. Is that clear? Is this particular part clear to you? Is this question clear to you? Because it's quite important to understand the type of the questions and from which particular date we have to consider the residual maturity. That is to be considered, right? Now after that we have to calculate what amount in total will be there in 1 to 14 days bucket. What amount in total will be there in 1 to 14 days bucket? So I've already conveyed the idea to you that the amount for the current deposit, which will be in 1 to 14 days bucket, it is 17.8%. It was 17.8%, which we calculated to be 92.56. That was from the current deposits, right? That volatile part. And from the saving fund deposit, the amount we calculated to be 115.2. But other than that, the amount is also to be placed in 1 to 14 days bucket. Let's have a look at it. What amount will be placed, right? So we have to calculate the maturities from 31st of December, ahead of 31st of December 2020, 2019. We have to consider those particular dates, and for 1 to 14 days we are looking for. So it won't be basically like, let's consider the different typos which will be considered. Let's say that's particularly call money is maturing on January 3rd, so it will be considered. The repo is going to be mature on January 3rd, so that will also be considered under 1 to 14 days bucket over there. So these four components will be considered under 1 to 14 days bucket. So I'm just writing over here for your reference. Let's say for the call money which was to be considered, the amount is 30. And for the repo the amount is to be considered is 40. So that is to be placed over there. And other than that, the volatile part from the current deposit and further the saving fund deposit is to be considered. That will make it what? That will make it 30 plus 40 plus 17.8% of 520. That is particularly we calculated to be 92.56. And further plus the volatile part from the saving fund deposits, that's particularly 115.2. So these all four will be placed under what bucket? Under 1 to 14 days bucket. The total amount would be the sum total of the same, right? So it will be equal to 30 plus 40, that is equal to 70, plus 92.56 plus 115.2, that makes it 277.76. 277.76. That will be the total amount that will be placed under 1 to 14 days of the bucket. Is that clear? Kindly do confirm. And further, if you have been liking the video, if you are able to learn the concept from the same, do give this video thumbs up. If you look at the efforts we are making for this particular video series, so kindly do like the video and further give this video thumbs up. And if you have not subscribed to the channel yet, do subscribe the channel at the earliest. You can also be joining our CAIIB special group, where we'll be sharing each and everything related to these particular videos. We do share the PDF afterward the class over there. So for that particular purpose, you need to WhatsApp us CAIIB group and WhatsApp it to the number that is given over here below. That's 83609444207, right? We'll be sharing the link to you where you can join the group, right? So that will be actually related to it. Now let's move to the next question. It says, what is the total amount that will be falling under 1 to 3 years of the window? We have to calculate the total amount for the bucket 1 to 3 years. 1 to 3 years. As I told you, the rest of the part which is not volatile, the non-volatile part of current deposit and further the saving fund deposit, that will be placed under the 1 to 3 year bucket first of all. That is to be placed under 1 to 3 years of the bucket first of all. And also And also the other amount that we are going to talk about, which is will be placed under 1 to 3 years. 1 to 3 years means we will be considering 1st of January, after 1st of January, from after 1st of January 2021, like later on from 1st of January, starting from 1st of January 2021, we will be considering under 1 to 3 years, right? So for that particular case, we will be considering different things over there. So the first of all, the non-volatile part, it means 960 minus 12% from saving fund deposit, that will be considered. Plus also for the current deposit, it will be 520 minus 17.8%. 520 minus 17.8%, that is to be considered. And other than that, the dates ranging from the maturity dates ranging from 1st of January 2021 to 23 1st of January 31st of particularly, let's say December 2023 over there, those all things are to be considered from 1st of January 2021 to 31st of December 2023. These dates are to be considered, right? So these dates are to be considered for 1 to 3 years of the category. So it will be here, it will be falling under, I'm marking the particular time which will be considered under this range. And other than that, it will be let's say we are talking about which is expiring on maturity on uh, 5th of May 2023, and also on July this one, and for the this one and this one, these all will be considered. These all will be considered. I'm basically ticking those values, right? So these all five and plus one over there, these all will be considered over there. So the total amount over here is 100 plus 300, that is equal to 400, plus 200, that is equal to 600, plus 100, that is 700. 700 plus 270, that is 970, plus 150. So 970 plus 150, that is amounting to 1120. That is 11 that is amounting to 1120. So those all to be considered, and other than that, these two things are to be considered, right? So it will be 960 minus 12%, that is 844.8. 844.8. And 520 minus 17.8%, that is 427.44. 427.44 plus 1120. All right, so it will be 427.44 plus 1120 plus 844.8, that is the total amount, that is 2392. 2392.24, that is the total amount which is to be considered under 1 to 3 years of the bucket. Is that clear? Right. So with that particular case, we have already sold our case study for the structural liquidity statement. I hope that this particular case study should be clear to you for now. Okay, now let's move to the another chapter that's related to the another module C over here. So in module C, we are having 6 chapters. We are having 6 chapters, and we will be covering all those 6 chapters in just 3 to 4 days. We'll be trying our best so as to cover in just 3 to 4 days over here. So first of all, it's related to the introduction part, and it's the what is treasury. So it's actually related to the intro of treasury, that what actually the treasury is. So if we talk about the treasury, previously it was just used for the liquidity management. So previously, if we would have talked about the treasury, it was all related to managing the liquidity of the bank over there, right? But now it's not only related to the liquidity management, but other things are also there. So it's actually related to the deploying of funds, that whatsoever the surplus funds are lying with the bank, right? So that particular part is also done by the treasury department now. And other than that, it's related to sourcing of funds now, from where we will be getting the funds, from interbank markets or from other markets, from foreign market, from where we'll be getting the funds over there. So those all parts are to be considered. So we are not basically limited to one particular thing, but we are basically carrying it to the another thing. That's part one. It's related to managing the liquidity. That's so as to manage the liquidity risk management is to be done. And further, we are to manage the adequate cash balances with us for the day-to-day requirements over there. And other than that, we must be deploying the surplus of the fund. So if there is any surplus, that is to be deployed over there. And the third one is related to from where we are to source the particular funds over there, that is to be done. That is to be done. And in banking sector, particularly if we talk about, we are also to manage the reserve requirements. Now what do you mean by reserves? So as per the statutory requirement, there are the different reserves, those are to be maintained. Like we are having the CRR, that is a cash reserve ratio. We are having the SLR, that is a structural liquidity ratio. Those all are to be maintained. those all are to be maintained. So we are to maintain the CRR with the Reserve Bank of India. We are to maintain the SLR secure in the form of securities or approved securities or in the form of cash balances or something like that. So in all the cases, this is the duty of the Treasury Department. This is the duty of the Treasury Department. And also in the case of SLR, where you are to basically, let's say, invest the money into approved securities, that is also done by what? That is also done by the Treasury over there, right? So that's actually related to it. So Treasury, we can say, connects the core activity of the bank with the financial markets. Let's say if we are having the bank over here, let's say we are talking about the ABC Bank, right? Now ABC Bank should be connected to the interbank market. It is connected to the interbank market, just like a call market, money market, term market. It is connected to the same. It is also connected to the capital market. It is connected to the foreign exchange market. Now that particular part will be done by whom? That will be done by the Treasury Department itself, right? And after that, it's related to the risk management. So also in the smaller bank, Treasury acts as ALM support group. The Treasury act as the ALM support group in case of the smaller banks. In case of the smaller banks. So risk management component part is also done by whom? It is also done by the Treasury. Risk management component is also performed by the Treasury over there. And after that, it's related to the integrated Treasury. The next concept we are to talk about, it's actually the integrated Treasury. What do you mean by integrated Treasury? Where each and everything is interrelated and connected with each other over there. That's the integrated over there. That we are not only confining the Treasury to one particular market, but we are basically keeping it up to the different markets. Like we are keeping it to the securities market, we are keeping it with the capital market or money market. So we are also taking it to the money market, we are taking it to the security market, and also we are taking it to the foreign exchange market. So we are not confining the market to one place of the market, right? So it's actually related to, it's actually a direct result from financial reforms. So there were the financial reforms. There were the financial reforms. There was globalization. There is free flow of the capital, and for the also the flow of capital in the different currencies. So even if there is flow of the capital in the different currencies over there, it should not be considered the same in the different manner over there. It can be considered the same manner. Let's say in today era, if you are receiving the USDs, or if you are receiving the Canadian dollars, that's any of the convertible currency that you are receiving over there, you will not be considering it as a different stream of the currencies over there, right? So that is the main thing, because it's totally convertible. Now you're having the ECBs, you're dealing with ECB, that is external commercial borrowings. You're dealing with the ODIs, that is the overseas direct investments over there. We are dealing with the FDI, that is the foreign direct investments over there. And also the government has paved the way related to the investment into different sectors over there, and without any cap, you can be investing into different sectors. That's the main thing related to it. So banks are having the larger area due to the financial reforms, that the banks can be investing in the different forms over there, right? The banks are having the different resources also. Like the banks can be having the foreign exchange reserves. Banks can be having the foreign exchange reserves from the interbank market. They can be having the foreign exchange reserves from the nostro account. They are basically maintained with the correspondent banks out there. And they can also be having a line of particularly LC. They can be having a line of particular control. Sorry, that they can be having the line of credit, not line of control over there. They must be having, they can be having the line of credit from the other banks over there. They must be having the accounts of the individuals in the form of EEFC account, that is exchange general foreign currency accounts, or it could be related to DD account, that is a diamond dollar account over there, where the people do park their extra money over there, right, in the form of foreign currency over there, and further that can be utilized by the banks out there, right? So that's the case. So the banks are having the different streams of the resources. The banks are having the different venues where the bank can be putting money into, where the bank can be investing the money into, and that basically gave the result to integrated treasury, right? That basically is a integrated treasury is a result of the same. Now, what are the different functions? If we talk about what are the different functions of the integrated treasury, let's have a look at it. What are the different functions related to the integrated treasury? First of all, we are to meet the requirements of cash reserve ratio as well as the statutory liquidity ratio, right? That's the first thing. And second thing, it's related to the global cash management. The cash management is to be done, that the bank must be having adequate level of the liquidity, that is actually related to the global cash management, that is to be done over there. And other than that, if any kind of the merchant services to be imparted given that is also to be done on the part of the treasury department. Like let's say proprietary positions to be taken for the bank itself, but if you have to take the positions for your customers, that's a merchant, let's say services, those are to be imparted. Merchant services are to be imparted, right? And other than that, it's also related to optimizing the profits. Optimizing the profits, you can be exploiting the different positions of the market out there, that is the arbitrage. The bank also do go for the arbitrage, so optimizing profits is also a major part for the banks, for the treasury, that is to be done, right? That is optimizing the profits over them. The fifth one, it's related to, I have already conveyed, risk management. The risk management is to be done, that is also the duty of the treasury. And also, other than assisting the bank in management of asset liability management, so doing ALM, that is asset liability management, is to be done. So there is any maturity mismatch between the different maturity ladders or time bucket, that is also to be done and also to be maintained by the treasury itself. That's also duty of the treasury over there. Is that clear? Now, the treasury is having the three different distinct roles. So we can say it's about the different roles of the treasury. So we can say it's about the different roles of the treasury. The first role, which is actually related to, that's the main thing, that's the liquidity management. It's actually related to the liquidity management. Now, what do you mean by liquidity management? Now, the treasury is actually responsible for managing the short-term funds across the different currencies, and also so as to comply for the CRR and SLR requirements. That all comes under the liquidity management role over there. The second component, the second main component, is actually related to the proprietary positions. It's related to the proprietary positions. Now, what do you mean by proprietary positions? Now, let's say if I want to invest the money for my own, that is said to be proprietary positions. Let's say the treasury wants to invest the money into different currencies, different securities, other financial securities or instruments like derivatives, that basically is going to contribute into the bank's own profit, right? That is a proprietary position. That is the proprietary position. That's the second important role. And further, the third one, it's related to risk management. So whether it's related to managing the maturity profiles, whether it's related to managing the liquidity statements over there, that all things come under the role of risk management by the treasury, right? So these are the three different important roles which are to be played by the treasury over there, right? So it's actually related to it, and further also related to multiple roles of the treasury. It's actually the multiple role of the treasury. Now treasury actually do maintain the ALM book. Now ALM is actually related to asset liability management. Now if the bank is having the different assets and different liabilities which are maturing at the different dates over there, definitely there will be a mismatch of the same. So that is to be done, and that's a traditional thing that which was previously also being done by the treasury over there. That was a traditional thing. So I'm just writing over there that it's a traditional part which was previously also performed by the treasury, which was previously also was performed by the treasury, and nowadays also performed by the treasury itself, right? And the second one, it's related to the merchant book. Now, when we are maintaining the positions for our customers, let's say our customer want to purchase 10,000 USD, we have to basically maintain that particular position. Our customer want to purchase the derivative, we have to maintain the position. That is to be done under the merchant book over there. And the third one, it's related to trading book. The third one, it's related to trading book. Now, what do you mean by trading book? That when you have to manage your own proprietary positions, that is said the to be the trading book. So these are the multiple roles which are to be performed by the treasury out there. Is that clear? Is this particular part clear to you? Right? Is this particular part clear to you? And further, after that, it's actually related to the role of the particular. We are going to have the evolving role of the treasury as a profit center. Now previously the treasury was not considered to be as a profit center, but nowadays the treasury is considered as a profit center. So I'm just writing over here. So the treasury is now considered as profit center. Why it is considered as profit center? Now let's have a look at it. Now treasury do operate in interbank markets. Now, in case of interbank market, there is negligible credit risk. In case of the interbank market, there is negligible capital risk, credit risk, and also a very low capital is to be maintained. So the treasury can basically be getting the money from that particular channel, and further we can be utilizing it under the more accurate channel or more earning channels, right? And also, as I told you, a very low capital is to be maintained, risk capital is to be maintained. The treasury activity is highly leveraged. So we can simply be writing activity of the treasury is highly leveraged. So it's not the case that you're not going to earn the money. It's a case that, let's say, if you have invested the money of rupees 100, you're just to maintain the margin over there, and you can be owning the sources of rupees 1000 or rupees 10,000 and so on. So it is highly leveraged. And also, the operational cost is very low. Operational cost is low as if we compare it with the other banking styles. Let's say if we are comparing it with the retail banking, if we are comparing it with the commercial banking, definitely the operational cost is very much low, activity is highly leveraged, and also the treasury do operate in the interbank market where the credit risk is very much low. The bank is not to maintain very high risk capital, so that it is highly leveraged over there and very much profitable business, right? Now, let's have a look at the different sources of the, or we can say different avenues, right? Profit sources. We are going to talk about the profit sources over there. There are two types of the profit sources. One, it's related to the conventional sources, and the other one, it's related to contemporary sources, right? We are going to talk them about all, right? First of all, we are going to consider about the conventional sources. What are the different conventional sources? Now, first of all, it's actually related to the foreign exchange. Now, foreign exchange is actually related to what? Let's say I purchase the USD at 78 rupees and I'm selling it at 84 rupees, or I basically sold it at 84 rupees and purchased it at 78 rupees or at a lower price. I'll be earning the money in both the cases. Now, if we basically want to earn the money in that particular scenario, we are to basically play with the difference between the purchase price and the selling price, which is known as the spread. Which is known as the spread. Let's say case I have purchased it at 77, I'm selling it at 84. My spread would be equal to what? It will be equal to 7 rupees. It will be equal to 7 rupees over there. So that way, particularly, the treasury can earn money. The second way, it is actually related to money market deals. Now, what do you mean by money market deal? The bank is actually dealing in the different money markets. Money market is basically the instruments are ranging from 1 day to 1 year, up to 1 year, but not more than that. So it's actually related to the bank can be investing the money or can be lending the money in for short-term purposes. For short-term purposes. So if the bank is having the surplus with them, they can be lending in the interbank market where the bank will be earning well off, right? So that was the case related to it. So that's the money market deals. The third way, it was related to the investment activity. It was related to the investment activity. Now, if the treasury is investing into government securities, which is actually being done so as to satisfy the role for the SLR, that is a statutory liquidity ratio, because it's mandatory for the scheduled commercial banks so as to maintain the SLR. A fixed percentage of the net demand time liabilities is to be maintained as the SLR. And for that particular purpose, major of the banks go for what? The banks go for the approved government securities, which must be unencumbered, right? And for that is to be maintained throughout the India. So in that particular scenario, the banks can be earning, if the banks are investing into the particular government securities or approved securities, the bank earns money on it, right? So that's the case. So that was an investment activity. And also the strategic investment deals can also be done by the treasury, like investing in the subsidiaries or the particular associates to venture into the other business lines over there. That can also be done. That can also be done. So these three are the conventional sources where the treasury can be making money, right? Now we're talking about the contemporary sources. What are the different contemporary sources? The first one, it's related to the interest arbitrage. The first one, it's related to the interest arbitrage. Now, as I told you that treasury is actually not dealing in one market. They're dealing in across different markets, right? And further, they particularly operate the currency, they operate the security markets. Hence, particularly, they can be maintaining one position in one particular market, and further can be selling that particular position in the other market so as to make the profit out of it. That's particularly said to be the arbitrage. So simultaneously, if we do like that, let's say we are dealing in one market, and at the same time, let's say I purchased the thing from one particular market, and at the same particular time, I basically sold the instrument in the other market, and I exploited the prices in the different markets. That's a arbitrage, and I can be making direct profits out of it. I can be making direct profits out of it, right? So that's the case. And for also it may be the case that the bank may be borrowing the money in the money market, and further they could have invested the money into the particular, let's say, short-term commercial papers or particularly treasury bills over there so as to make profit out of it. So that can also be done. Let's say case I got the money at 7% and I invested the money at 9%. Now both are secured markets and I'll be making the money out of it. So that can also be done by the treasury over there. So that's actually related to the interest arbitrage. Both the cases are known as the interest arbitrage. And the second one, it's actually related to the trading. The second one, the second contemporary source of earning or profit making, it's actually related to trading. Now trading is actually what? Trading is some speculative activity. Let's say you just speculate that the prices will go higher, and further if it's favorable, then definitely you'll be earning the money out of it, right? So treasury can be buying low, that's particularly can be over buying the particular currency or particular security over there. It can be going short also, that's selling the particular securities, right? So the treasury can be maintaining both the positions. It can be having a long position, it can be having a short position too, and treasury can also be investing into the different swap currencies over there, and further can be playing along with the changing market dynamics so as to make the profits out of it. And also the banks who are having the authorized dealer license, which is actually given by the Reserve Bank of India, they can be trading in the currencies also. So that can also be done. But I'm telling you, it's a speculative activity. It can be having a negative impact too, it can be having a positive impact too, but the dealers who are there in the dealing room, they are basically well versed with the different capabilities so that they can be judging that this particular market will go up or down, right? So that they can make a huge profit for the banks over there, right? Further, these were the two ways where the particularly treasury can be making the profits, right? And after that we are going to learn about the treasury products, right? Treasury products. But before that, let's learn about the organization of treasury. Let's just learn about the organization of the treasury. Now you can be actually be organizing treasury as a department in the head office, right? And also the treasury can be operated as a bank branch. So it can be established as a branch, different branch, and it can be established as a department over there. But let me just tell you one thing, this particular branch status is preferred. This one is preferred. Why this one is preferred? First of all, you can be maintaining different books for the branch. Okay, so the branch books can be maintained, just let me write over there, books can be maintained independently. You can be maintaining all the books like profit loss books. These can be maintained independently, right? That's the first thing. And also, let's say they can be having their own profit and loss account, they can be having their own GL subhead accounts over there. And further, the specialized branch is having an additional advantage. If this particular branch is having the authorized dealer license, if the branch is having the authorized dealer license, in that particular scenario, this branch can be participating in clearing and settlement system. It can be participating in clearing and settlement system over there. Otherwise, if I basically set up the treasury as a department in the head office, then definitely you are to do the transactions through a branch only for payment and settlement systems. For clearing and settlement system, you have to basically act only through the branch over there, because the head office department cannot be acting independently so as to participate in the clearing and settlement system out there, right? So that's the case. Okay. And in the case of the treasury, if we just talk about who is the head of treasury, so particularly it's headed by a senior management person. It's actually headed by a senior management person who will be a GM, who will be a general manager, or particularly said to be CTO, that is a chief treasury officer. The person will be said to be the CTO, that is a chief treasury officer, who will be the vice president of such designation, something like that, right? So it is headed by senior management person or GM person over there. Okay. Now, the treasury is actually segregated into three parts. If we talk about the treasury over there, let's talk about the treasury. And further, if we talk about how it basically works, so it is basically divided into three parts. The first, it's actually related to the front office. The second one, it's actually related to the back office. And the third one, it's actually related to the middle office, right? And learning the working of all three parts of the treasury is very much important from the exam point of view, right? Because from exam point of view, this particular aspect is very much important, right? So first of all, let's talk about the dealing rooms. So in dealing room, we are having the different dealers. In dealing room, we are having the different dealers, and there is a chief dealer also. There is a chief dealer who is the head of all the dealers, but there are other dealers also. But there are other dealers also. Now, each dealer basically specializes one of the markets, like one may be specializing the foreign exchange market, on the money market, or particular securities market. But generally, dealers are familiar with the working of all the particular markets, whether we are talking about the money market or foreign exchange market or the capital market, they all deal with the same. And particularly if we talk about the securities market, if I'm going to talk about the securities market, this securities market is divided into two further parts. One, it's the primary market where we are dealing with the IPOs, etc. And the other one, it's related to secondary market where we basically deal with the already sold securities, right? And generally securities, जो securities dealers जो होते हैं, they basically deal with the secure secondary market only. The security dealers which are there in the front office, so we are having the dealers in the front office. So the security dealers, which they will be dealing with only with the secondary market, they will be dealing with this particular market only, right? Because they can also be dealing in the primary market, but that is out of what, that is actually out of the front office. That is not the component of the front office, that is out of front office over there. Is that clear? Is this particular part clear to you? Right? So there is the securities market is further divided into primary market and secondary market, but the dealers, security dealers in the front office, they deal with the secondary market, not with the primary market. I'll be letting you know what particular part deals with the primary market over there, right? And after that, it's actually related to primary market. Who deals with the primary market? It is a investment department. It is a investment department who deals with the primary market, not the securities dealer, because there is credit risk associated, and that is also to be looked into, right? After that, now let's learn about the working of the middle office. Now let's learn about the working of the middle office. Now, this particular department or this particular office is actually created exclusively to so as to provide the information to the management. So whatsoever the information that is to be provided to the management over there, that is so as to manage the information, management information system, that is a major part of the middle office. That is a major part of the middle office. And also it monitors the exposures or limits. It monitors the different exposures or stop loss limits of the treasury, and further also reports the same. So we have to say, we have to basically manage the stop loss limits or monitoring part over there, that is to be done by the middle office. And also it reports the same to the particular management over there, like whatsoever the key parameters, whatsoever the performance parameters are there, these are to be reported by the middle office to the particular management, right? That is to be done. And it's the middle office only which function as the ALM support group in the case of small banks. So let me just write over there that in case of the small banks, it do act as a ALM support group. It do act as a ALM support group, right? Is that clear? Kindly please do let me know. Is this particular part clear to you? Right? And further, After that, it's actually related to the back office. Now, back office is actually responsible for what? Back office is actually responsible for verification and settlement of the deal. So whatsoever the deals which are being entered by the front office, those deals are to be verified. Those deals are to be verified, and verification of the same and settlement of the same is to be done individually by the back office over there. So the deals are verified based upon the slips which are prepared by the dealers, and from the confirmation from the counterparties over there, back office will be confirming the deals independently. That is to be done independently, and also the back office take care of the bookkeeping. So whatsoever the part related to bookkeeping, that is to be done by the back office out there, and also whatsoever the periodical statements which are to be submitted to the Reserve Bank of India. So reports which are to be submitted to the Reserve Bank of India, that is also to be done by the back office over there. Back office also maintain the nostro account balances. So whatsoever the balances that is to be maintained in the nostro accounts for the deals, and further whatsoever the funding and the security accounts is to be maintained with the Reserve Bank of India. The demat accounts which are open with the depository participants out there, and also it basically ensures that a particular margin money is to be maintained with the CCI, that is a Clearing Corporation of India, right? So whatsoever the accounts which are being maintained, whatsoever the margin that is being maintained, that is to be done by the back office. That is to be done by the back office over there, right? Is that particular part clear to you? So this is actually the main related to front office. So front office deals with the working, the back office verifies the deals, manages the account, and the middle office manages the risks and further do the analyzing and monitor the same, and further report the same to the senior management. So that is actually related to the working of the particular different departments in case of the treasury. Is that particular point clear to you? Kindly please do let me know at the earliest if you have understood this particular points so far, if you have understood the same things so far. Now let's learn about globalization, and let's also learn that how it has impacted the functionaries of treasury. Now let's learn about the globalization. Now globalization is actually related to what? When our local market, when our local market or domestic market is dealing with the or interacting with the global market over there, right? It's dealing with the global market over there, definitely it is going to have impact. Let's say case there is actually inflow of the money from the global market to domestic money, there is huge money, let's say there is huge inflow of the money into the domestic market, definitely it's going to impact the interest rates, definitely it's going to impact the different things in the economy over there. So that is going to impact, so that is also to be considered, that is to be considered over there, because the FDI is allowed, that is a foreign direct investment is allowed. FIIs, that is a foreign institutional investors, are being allowed over there, who are investing actually money into the Indian markets out there. So fund flow on the capital account basically can take place through the different manners. It can be basically acting through the different manners over there. They can be fund flow like from the in the way of the portfolio investment. It can be from the direct investment. It could be in the form of the ECB, that is the external commercial borrowing. So if you're talking about the fund flow, we are basically talking about the fund flow over there. Now, what are the different ways of the fund flow? It could be related to the portfolio investments. Portfolio investments. Let's say case that the foreign institutional investors have invested into the portfolio, right? They have invested in the portfolio. It could also be the case, it could be related to direct investment, where the investments have put direct money into the different companies, like in the case of the FDI, etc. And further, it could be the foreign institutional investors also, and also it could be the way related to ECB, that is the external commercial borrowings. It could also be related to the mergers and acquisitions. It could be also from the result of merger and acquisition of the domestic and the foreign entities. It could also be related to payment for the technology transfer or the royalties or the financial services, etc., 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 right? So they can be the different ways the money can inflow from international or foreign countries to Indian country there, right? It can be the case. Now what is the impact of that particular capital flow? What is the impact? Now when the huge capital will be flowing from one particular country to the other country, definitely it's going to impact the money supply, it's going to impact the interest rate, it's going to impact the exchange rate, it's going to impact the inflation expectation and balance of payment of one country to the other country over there. And through these capital inflows only, through this capital inflow only, it's not the case that will be impacting very suddenly or very abruptly, but it will be having a long term impact. It will be having a long term impact. And also, if there is a sudden rise or fall of the portfolio investment by the investors, let's say 1 lakh crore or 2 lakh crore were invested into one particular country instantly, right? Definitely it's going to impact, it's going to change the dynamics of the markets out there. And domestic economy is also susceptible to what? It is susceptible to the systemic risk. Systemic risk, I've already told you, it's basically failure of particular one bank over there or one particular financial institution due to the failure of other financial institution, because those all are interrelated. Those all are interrelated. So government is basically imposing restrictions. Government is basically paving its way so as to give the different things related to how to regulate the cross border movement of the capital out there. So that's a different thing. That's a different thing. But RBI is playing a very crucial role in this particular part. In this particular part, RBI, that is Reserve Bank of India, is playing a very crucial role in case of globalization. RBI is basically given the different regulations under the Foreign Exchange Management Act that's actually related to limiting the capital account transaction convertibility, or it would be related to other things also. And also the ECD, that is the Exchange Control Department of the Reserve Bank of India, that's basically particularly renamed to Foreign Exchange Department. That was renamed to the Foreign Exchange Department, right? That is particularly given over there. And RBI, as I told you, has not fully permitted the convertibility on account of the capital account. There are two type of transactions. One, it is a current account transaction, and the other one is related to the capital account transaction. Current account transaction is fully convertible, but the capital account transaction is still now fully convertible because of this particular sudden capital flow, right? That is why it's there, right? Further, it's related to, if we look at the impact of the globalization, if we just look at the impact of this globalization, the impact is threefold. The impact is threefold. First of all, it's going to impact the interest rates. It's going to impact the interest rates, right? And further, it basically gave the formation of new industries, or let's say new institutional structures were being formed. CCIL, that is a let's say Clearing Corporation of India Limited, and for the NSDL, that is National Securities Depository Corporation Limited, CIBIL Credit Information Bureau Limited, credit rating agencies, these all infrastructures were built basically based on the globalization only, right? And also the Reserve Bank of India also has phased out the different product range. Different products are also there. So the first phase was it's related to interest rates, and the second one is related to new institution structure. So we can say simply new structure was there. And the third one, it's related to the product range. Now different product range related to different derivatives and different new products which will be basically be helping in the managing the capital flow. Those are given by the Reserve Bank of India, right? In a very phased manner, those have been given. Like the swaps are there now. We are dealing with the options over there, and basically also the forwards are there. These not only help in hedging, that's safeguarding ourselves, but also it help in trading and generating the profit in the dynamic market out there. So these are helpful, very much helpful in a way, right? Is that clear? So for today video, it would be just all this much that we are to cover over here, and I'll be sharing the PDF of this particular video just after this particular session in our group over there. So you can be joining the group where we'll be getting the case study videos of two subjects. More than 130 case studies I've already shared in these groups. So if you have not got the same, if you want to get the links of the same, you should be joining our CAIIB group at the earliest. Just simply WhatsApp CAIIB group to the number 83609444207, where you can be joining the same. And if you're having any kind of doubts or queries, do let me know at the earliest so that we can be solving the same. And also we will be solving the queries in the next video also. So do post your queries, and further do share this video, show your love to this particular video, give a thumbs up to this particular video. You can also be sharing this video among your friends and colleagues. You can be sharing it in as your WhatsApp status so that other people can also be looking into the same, right? So that will be all related to this video. Thank you so much, and see you again in the next video tomorrow.